They said it couldn't happen. They said the market was too controlled, too manipulated, too rigged for anything real to break through. And then this morning, you woke up to a $70 gap in silver. Not a pump, not a rally, a gap. The price jumped from $30 to $100 with no trading in between. Like the market skipped a heartbeat and woke up screaming. And right now, somewhere on a Manhattan trading floor, a risk manager is having the worst day of his career. Because that gap is not profit-taking. That's not volatility. That's the sound of a bank that can't deliver the metal they promised. That's the sound of a fractional reserve scam, the same one that killed Lehman Brothers, the same one that vaporized your retirement account in 2008, finally hitting a commodity they can't print. You want to know the scariest part? This was predicted, not by conspiracy theorists, by federal prosecutors, the same prosecutors who fined J.P. Morgan $920 million for manipulating this exact market, the same prosecutors who called it racketeering. And if you're sitting there thinking, this will blow over, they'll crush the price like they always do, you need to hear what happened in the last 72 hours that they're not telling you on CNBC, because three things just converged that have never converged before. A physical delivery demand from a sovereign buyer that can't be refused, a COMEX vault inventory at a 15-year low, and a short position held by 8 banks so concentrated that if one defaults, the entire paper market implodes. So before I show you the receipts, the court documents, the CFTC data, the vault withdrawal records that prove this isn't speculation, I need you to do something. Drop a comment right now and tell me, are you holding physical silver or are you still trusting paper promises? Because in the next 20 minutes, you're going to learn why that question isn't investment advice. It's a survival test. And if you want the unfiltered breakdown of how the biggest financial institutions in the world have been running a Ponzi scheme in precious metals for 50 years and why it just broke, hit subscribe. Because this video will get buried by the algorithm the second it gains traction. They don't want you connecting these dots. Let's start in 1971, not because it's ancient history, because it's when they made the decision that created the gap you're staring at right now. August 15th, Richard Nixon closes the gold window. The Bretton Woods system, the agreement that said every dollar could be exchanged for gold, dies on live television. The official story? Inflation, trade deficits, economic necessity. The real story? The United States had printed so many dollars to fund the Vietnam War and domestic spending that foreign governments were calling the bluff, showing up at Fort Knox, asking for their metal. France sent a warship to New York Harbor to collect physical gold. A warship. Sound familiar? That's what happens when trust in paper evaporates. So rather than admit insolvency, Nixon severed the link. From that moment forward, the dollar was backed by nothing but faith, military power, and a promise. And to maintain that promise, to keep the world believing in paper, they needed to control the price of the very assets that exposed the lie, gold and silver. Enter the futures market, the COMEX, a beautiful, elegant weapon disguised as a marketplace. Here's how it worked. Instead of buying physical silver, you could buy a contract that represented silver, a promise to deliver metal at a future date. Sounds reasonable, right? Farmers do it with corn, airlines do it with jet fuel. It's called hedging. Except the COMEX had a special feature, a loophole. You could settle contracts in cash instead of metal. And if you could settle in cash, you didn't actually need the metal to exist. You just needed the contract. Sound familiar? That's the exact structure that blew up the housing market in 2008. Except instead of mortgage-backed securities with no real mortgages, these were metal-backed securities with no real metal. By the 1980s, the futures market dwarfed the physical market by a ratio of 100 to 1. For every ounce of actual silver sitting in a vault, there were 100 paper claims on that same ounce. And the beauty of it? As long as everyone believed the paper was as good as the metal, the price could be set by the paper. Banks could print infinite contracts, flood the market, suppress the price. And every time silver started to rise, threatening the dollar, threatening the narrative, threatening the system, they dumped a fresh avalanche of paper contracts, crashing the price before physical buyers could react. The Hunt brothers learned this in 1980. They tried to corner the physical silver market, buying millions of ounces, driving the price from $6 to $50. The COMEX responded by changing the rules mid-game. They banned long positions, forced liquidation, crashed the price 50% in 4 days. The Hunts were destroyed, bankrupted, and the message was clear. You do not fight the paper. Sound familiar? GameStop 2021. Robinhood shuts off the buy button. The rules change when retail wins. Fast forward to 2008. The financial system collapses. Banks are insolvent. Lehman Brothers evaporates. AIG needs a bailout. And in the chaos, silver, the asset that's supposed to be a safe haven during crises, drops 50%. How? How does a tangible physical commodity with industrial demand collapse during a credit crisis when everyone is fleeing to safety? Because it's not a free market. It's a controlled market. and the controllers were liquidating everything to cover their derivatives exposure. But here's the part they didn't expect. The physical market didn't follow the paper. Coin dealers ran out of stock. Premiums exploded. You could see the spot price at $10 on your screen while actual silver eagles were selling for $25 at your local shop. The market had bifurcated. The illusion was cracking, and the banks knew it. Between 2008 and 2024, the evidence became undeniable. Deutsche Bank settled for price manipulation. JP Morgan paid $920 million in fines for spoofing the metals market, a practice where traders place fake orders to manipulate prices, then cancel them before execution. HSBC, UBS, Barclays, all fined, all caught, all documented. The Department of Justice didn't call it market inefficiency. They called it fraud, racketeering, a criminal enterprise. Sound familiar? Because the same banks that rigged LIBOR, rigged foreign exchange, rigged mortgage-backed securities, were also rigging the metals market. It's not a bug, it's the feature. Control the price of money's alternative, and you control perception of money itself. But here's the problem with running a fractional reserve scam in a physical commodity. Eventually, someone asks for delivery. And when they do, the game ends. The pandemic hits, supply chains fracture, mints shut down. And for the first time in decades, industrial users and the companies that need physical silver for solar panels, electronics, medical equipment, start competing directly with investors for the same limited supply. The COMEX had always relied on a gentleman's agreement. Most contracts would roll over or settle in cash. Physical delivery was rare, discouraged, expensive. But in March 2020, something broke. Spreads between physical and paper exploded to record levels. The futures price said $15. Dealers were selling coins for $30. And when investors started standing for delivery, actually demanding the metal their contracts promised, the COMEX inventory started draining. 40 million ounces withdrawn in 6 months. Then another 30 million. The entire eligible inventory, the metal available for delivery, dropped from 150 million ounces to under 50 million. And the shorts panicked. Because here's the thing about naked short selling. It works beautifully in a market where nobody asks for delivery. You can sell promises forever. But when the buyer says, I want the actual metal, you have two choices. Buy it at any price to cover your position, or default. Enter the second mechanism. The one nobody talks about. The one that makes this entire scheme possible. The concentrated short position. In a fair market, short selling is distributed. Thousands of participants, balanced risk. But in silver, 8 banks held over 65% of the entire short interest. 8. And 3 of those banks held over 50% by themselves. This isn't market making. This is systemic control. And when you concentrate that much short interest in so few hands, you create a single point of failure, one default, one margin call, one forced liquidation, and the entire structure collapses. The CFTC knew, they published the data. The Commitment of Traders report showed it every week, but they did nothing. Because the banks shorting silver weren't rogue actors. They were the designated market makers, the authorized participants, the institutions with direct access to the Federal Reserve's discount window. You won't believe the name of the bank that held the largest short position. The receipt is wilder than you think. Let's talk about JP Morgan, not as a villain in a movie, but as a case study in institutionalized fraud. Between 2008 and 2016, JP Morgan accumulated over 800 million ounces of physical silver, not contracts, actual metal. They bought it quietly through their vault operations, their ETF custodianship, their London operations. At the same time, their trading desk was shorting silver futures on the COMEX, suppressing the price. Think about that structure. You were selling paper promises to drive the price down while simultaneously buying the physical asset at the artificially suppressed price you just created. It's not trading, it's theft with a Bloomberg terminal. The mechanics work like this. A JP Morgan trader places a massive sell order, say 5,000 contracts representing 25 million ounces of silver. The order hits the market. Algorithms see it. High-frequency traders react. The price drops. Other traders panic and sell. The price drops further. Then, before the order executes, the JP Morgan trader cancels it. The sell order was never real. It was a ghost. But the price movement was real. The panic was real. And in that chaos, JP Morgan buys physical silver at the now depressed price. They did this thousands of times. The DOJ documented it. Traders testified to it. The fines were paid, $90 million. Not for market inefficiency, for fraud. Now multiply that by the paper to physical ratio. For every ounce of silver in the COMEX vaults, there are, conservatively, 100 to 200 claims on that ounce in the form of futures contracts, ETF shares, and unallocated accounts. This is fractional reserve banking applied to commodities. The same scam that caused bank runs in the 1930s, now running 24/7 in the metals market. And it works perfectly until it doesn't, until physical demand exceeds available supply. until the contracts come due and there's no metal to deliver. In 2020, the cracks appeared. The COMEX changed its delivery rules mid-crisis, allowing 1,000-ounce bars from London to satisfy New York contracts, bars with different standards, different chain of custody, different refining requirements. Why? Because they were running out of eligible metal in New York vaults. Let's talk about SLV, the iShares Silver Trust, the largest silver ETF in the world. The prospectus is very clear. Shares represent ownership of silver held in trust. Sounds good. Except the fine print says the trust can hold unallocated silver, meaning silver that exists as a ledger entry, not as a physical bar with a serial number in a specific vault. And the authorized participants, the banks that create and redeem ETF shares, can deliver this unallocated silver to satisfy creation requests. So when you buy SLV shares thinking you own silver, you might own a claim on a promise to deliver silver. Layers of abstraction, layers of counterparty risk. And who's the custodian of SLV? JP Morgan. The same bank that paid $920 million for manipulating the market, they're now the custodian of. The moral hazard is obscene. They set the price, hold the metal, and profit from the spread between paper and physical. Here's where the current situation gets apocalyptic. In January 2021, retail investors on Reddit's Wall Street Bets noticed the same patterns institutional players had been exploiting for decades. They started buying physical silver and SLV shares en masse, explicitly trying to break the paper manipulation. The establishment media response was immediate and coordinated. Silver squeeze is fake. It's a distraction from GameStop. Don't buy silver. CNBC, Bloomberg, Financial Times, all running the same narrative within hours. Why? Because a real silver squeeze exposes the entire charade. If millions of retail investors demand physical delivery, the COMEX and LBMA would default. The paper market would collapse. And every central bank, every bullion bank, every institution that's been suppressing precious metals to prop up fiat currencies would be exposed. The numbers are staggering. Global silver mining production is approximately 880 million ounces per year. Industrial demand alone is approximately 550 million ounces per year. Investment demand is approximately 250 million ounces per year. That's a deficit every year for over a decade. Where's the shortfall coming from? Above ground stockpiles, strategic reserves, central bank leasing programs where they lend metal to bullion banks who sell it into the market, suppressing prices, then return paper promises instead of physical metal. It's a one-way trip. Once the metal leaves the vault and enters industrial applications, solar panels, electronics, medical devices, it's functionally gone. It doesn't get recycled economically. And yet the paper price suggests abundant supply. Remember Silicon Valley Bank? Signature Bank? First Republic? They collapsed because they were holding long-term bonds at face value on their balance sheets, while the actual market value had cratered due to rising interest rates. When depositors wanted their money, the banks had to sell bonds at a loss to raise cash. The fractional reserve system, where banks only keep a fraction of deposits as actual cash, broke down. The same structure exists in silver. The COMEX, the LBMA, the ETFs, they are all holding fractional reserves of physical metal against a massive overhang of paper claims. And just like SVB, the system works until everyone asks for their money at once. Except with silver, asking for your money means asking for delivery of physical metal. And there isn't enough to go around. A gap up in trading means the price opened significantly higher than the previous close, with no trading in between. It's a signal of extreme imbalance, more buyers than sellers, and the market leaping to find equilibrium. A $70 gap in silver from approximately $30 to $100 represents a 233% move. That's not volatility, that's a structural break. What likely happened is this: a major institutional player, a sovereign wealth fund, a manufacturing conglomerate, a billionaire who read the same data we're discussing, stood for delivery on a massive futures position. The bullion banks scrambled to source physical metal and couldn't find it at anywhere near the paper price. They were forced to bid up the physical market to cover their short positions. The paper price, unable to maintain the fiction, snapped to meet physical reality. This has happened before on smaller scales. In 1980, silver hit $50. In 2011, it briefly touched $49. Each time, the establishment crushed it back down through coordinated futures, selling, margin requirement increases, and outright rule changes. But here's why this time might be different. The deficit is structural now. Industrial demand is inelastic. You can't build solar panels without silver. Investment demand is global. Asian central banks are buying, and the available above-ground stockpiles have been depleted by a decade of deficits. The bullion banks are trapped. They can't print physical silver, they can't change the laws of geology, and if they default on delivery, the entire fractional reserve commodity system collapses. The greed was assuming the music would never stop. The illusion was that paper could always substitute for physical. The moral hazard was allowing the same banks that caused 2008 to run the same scam in a different market. And the engineered collapse is happening right now. Because when you build a financial system on borrowed time and borrowed metal, eventually someone asks for the receipt, and the vault is empty. Here's what makes this moment different from 1980, different from 2011, different from every other time they've crushed the silver price. The system is global now, faster, more leveraged, more interconnected. When the COMEX breaks, it doesn't just affect New York. It affects London, Shanghai, Mumbai, Zurich, every market that's been trading paper claims on the same physical metal. And the stakes are higher. Because silver isn't just money, it's industrial infrastructure, it's the energy transition, it's medical technology. When the price dislocates this violently, it doesn't just hurt speculators. It threatens supply chains, manufacturing, entire economic sectors built on the assumption that silver would always be available at suppressed prices. The lesson here isn't buy silver and get rich. The lesson is about denial, about the danger of trusting institutions that have been caught, fined, and prosecuted for the exact behavior they're still engaging in. The Federal Reserve tells you inflation is transient. The COMEX tells you silver is abundant. The bullion banks tell you the paper price is real. But your grocery bill says otherwise. The coin dealer's empty shelves say otherwise. And the $70 gap up says otherwise. We've been here before. We've seen the playbook. The difference is whether we're wise enough to recognize it before the collapse or just sophisticated enough to rationalize it afterward. So here's my question for you. Are we wiser now? Or are we just walking the same path in better suits? Drop a comment. Tell me if you're stacking physical or still trusting paper. Tell me if you think this gap holds or if they'll crush it back down like they always do. And if this breakdown helped you see the machinery behind the curtain, the mechanisms they don't teach in economics class. Subscribe. Share this with someone who still thinks markets are free and fair. Because the squeeze isn't coming. The squeeze is on.